Out of the multiples, what we have been discussing in the market-based valuation or relative valuation, one of the multiples analysts use is price to sales ratio. So it is basically price per share and sales per share. So it's not a sales in a total value of sales. It is rather sales divided by number of outstanding common stocks. So sales per share is the denominator and price per share is the numerator. So this is the idea of the price to sales. So let's discuss what are the rationales for which price to sales ratio is likely to be used. So one of the very first point is that compared to EPS, which is the denominator in the price to earnings ratio, and book value, which is the denominator in the price to book value ratio, the denominator here is sales. And you know very well, compared to EPS, compared to book value, the sales is not very easy to manipulate. So sales is less likely to be manipulated. So it is more useful in the multiples if we use this denominator. And you can recall that by choosing a preferential policy, managers may engage in raising the EPS when they find it rewarding. So another problem which we find in the price to earnings multiple is the earnings can be negative. In that case, price to earnings becomes invalid. So in that case, which can be alternative? So price to sales can be an alternative. And why it is a good alternative? Because you know very well that sales cannot be a negative number. So sales are always positive. And it has been found that in empirical evidence that for mature companies, for cyclical companies, and also for distressed firms, the price to sales is more appropriate for valuing the stocks of this kind of companies. And compared to price to earnings ratio, it has been found that price to sales is more stable ratio. So just to give you a slight idea that for the presence of operating and financial leverage, earnings is likely to fluctuate over time for the fluctuation in the operating and financial leverage. But you see, sales is a number which is the first number in the income statement, and that is not likely to be affected for the changes, for the variation in the operating leverage and the financial leverage. But you see, the earnings is the last number in the income statement, so that is likely to be affected for what is happening in the income statement throughout the stages when you are moving from sales to earnings. So compared to price to earnings, price to sales is more stable. And compare similar to other multiples what we discussed earlier, price to sales is also one of the factors which has been found in the empirical evidence that it also explains the cross-sectional variation in the stock return. So cross-sectional variation in the stock return. If some stocks gives higher return, if some stocks gives lower return, one reason might be that they have higher price to sales ratio, or they have differences in the price to sales ratio. Okay, so in comparison to the rationales or positive reasons that why price to sales ratio is to be used, let's see that some of the drawbacks of price to sales. So let's try to understand that sales, which is the denominator in the price to sales, sales is not equal to earnings and cash flow. What does it mean? So some firms may engage in accelerating the sales by taking some aggressive policies. So they may be able to generate higher sales, but it does not guarantee that these sales will be translated to higher earnings or higher cash flow later. So for that reason, the sales becomes less useful for valuing a stock of a company. And in the price to sales ratio, it is a point that numerator and denominator is not consistent. Let's try to understand it. The price and the sales, this is the numerator, this is the denominator. Okay, this price is of which of what price? Could you please write on the chat box? This price, is it the price of total firm, or it is the price of stock only? The price what we are mentioning here, it is the price of stock only, or this is the price of the total firm. Okay, this is not the price of total firm, this is the price of the stock. This is the price of a stock only. Say, so you see that the firm is financed by both stock and bond. But you see the sales which you are taking, this sales is of the firm's sales, or the sales which is contributed by the total capital. Total capital is contributing the firm to operate, and that is also generating the sales. So you see that numerator what you have taken is this one, but the denominator which you have taken is partial represent it is the total representation of the firm. Sales is a single number, it is the total representation of the firm, but the price, this price is the price of a stock. The stock is not the total representation of the firm. It would be the total representation of the firm if we take the price of both the stock and bond together. So that's why the price to sales, the numerator and the denominator are not consistent for this ratio. So what would be the consistent? So instead of price in the numerator, if we take the enterprise value. Are you familiar with the enterprise value? We talked about it in the free cash flow valuation. So this enterprise value represents the value of entire firm. The enterprise value is the enterprise value is the representation of the entire firm. Okay, someone is asking that slide 2 is showing now. Yeah, I'm writing on the slide. I'm writing something on the slide. You can't watch it? What you are watching on the slide? What you watch on the screen? Okay. Can you watch the screen where I'm showing the price to sales multiple drawbacks now? Is it now okay? Okay, we are discussing on this part. So the numerator is the representation. If we take the enterprise value and the sales as a denominator, in that case, these are consistent. But if we take the price only, which is the stock price, which we take in the price to sales ratio, those are not consistent. So that is the issue here. And when we take the price to sales, we do not account for the differences in the firm for the cost structure or cost differences. So some firms may generate sales at a lower cost, some firms may generate sales at a higher cost. So for the latter firm, the EPS should be a lower number, but we are disregarding this cost in the price to sales ratio because we are starting with the very first line item. So that's why you are ignoring the cost differences in the price to sales ratio. And again, I like to emphasize on this part that sales can be manipulated for the accounting practices. You probably can recall the aggressive accounting policies. In the aggressive revenue recognition, there is a policy which is known as bill and hold. Bill and hold. It is a such kind of aggressive policy in the sales recognition or revenue recognition, where we or the managers bill a particular customer for certain amount of products, but the goods are still yet to be delivered to the customer's place. So here there's a risk that customer will decline the invoice or customer will decline the acceptance of this product. So for doing this policy, the sales is likely to be a bigger number, but it's not likely that it will be it will later be returned, or it will be later adjusted if the customer is not accepting this. Okay, so these are some examples that how the sales can be misleading. So overall, the price to sales can be less useful. Okay, so you probably can recall that with each multiple, we are inviting a justified multiple for that respective multiple. So how can we come up with a justified price to sales ratio? Justified price to sales ratio. So let's work together. Then we'll try to explain that how the price to sales is influenced by some factors. Okay. Can you recall the justified trailing PE? Can you recall the justified trailing PE? I want to get response from you before writing it here. You can write in the chat box, justified trailing PE. Would you please write on the chat box? Okay. So let me try. We wrote the justified price to sales in this way. Can you recall this now? Trailing PE. Is this one we saw earlier? Confirm it, then we'll continue. Okay, you are confirming it that you have seen it. Okay, fine. So what we are doing, we will be doing some simple adjustment for getting this form. Okay, so let's see. So if I keep the price here and transfer the trailing earnings here and keep other things as it is. Okay. Now, if we divide both sides by this one, the sales per share, the latest one from the 0, you indicate it is the most recently available sales number per share. And we are writing here E naught divided by sales naught. Have we written the things? Is it okay that what we have written? We just have divide both sides by the sales per share. Okay, this one, let me take a new color, so that will be good. Okay, does it look like a profit margin? Earnings over sales, net income over sales. It is in terms of total, it is the net income over sales, and in terms of per share, it is the earnings per share and sales per share. Does it look like a profit margin? Yeah, it looks like a profit margin. So this portion is the profit margin. This portion is the profit margin. Okay, let me write here profit margin. And this part 1 minus B, can you recall what is it? 1 minus B, was it the payout ratio or is the retention rate? Can you recall? One minus B. 1 minus B is equal to payout ratio. B is equal to retention rate. So it is the payout ratio. It is not the retention rate. B is equal to retention rate. Okay, it is the payout ratio, and we know it is the growth rate 1 plus G, or G is the growth rate. Okay, so what do we see? Other things remaining same, justified price to sales of a firm is likely to go up for higher profit margin or for higher payout or for higher growth rate. Is it self-explanatory from the ratio, from the numerator? Yeah, you understand this? From the numerator, you see that this is the profit margin, this is the payout ratio, this is the growth rate. So what we are saying, for higher profit margin, the price to sales, justified price to sales is a bigger number. For higher payout ratio, the price to sales is likely to be a bigger number. For higher growth rate, the price to sales is going to be a bigger number. Is it clear now? So you see that G, can you recall that we also decomposed G in earlier discussion? So G is something which can be written in this way. This G, what we have written in the numerator, and it is also common in the denominator. But let's look at this first. So G is this. We can further break down the G into retention rate into the return on equity. And you see that this return on equity can again be decomposed into this part. Is it familiar to you, this part? What is it? What kind of decomposition is it? It is. So this is the dew point three-factor decomposition. So you see that all these factors, what we have discussed here and what we have found here, all these factors are influencing the justified price to sales ratio. So if I give you the question, or if I make you the question that if the leverage, which is the leverage here, this part, if leverage is likely to be a higher for a firm, what is the likely response in the price to sales ratio if other things remaining same? So you have to think it in this way. Okay, so in terms of the decomposition, you have to think of. Okay, so let's return to the multiples. We have the price to cash flow multiple, and let's discuss the rationale first of the price to cash multiple. Then we'll look at some other drawbacks of this multiple. Okay, so from the term, you can easily understand what is it. It is the price per share. Let's take the red color pen again. Price, then cash flow per share. Okay. So you can easily understand that compared to earnings, compared to book value, compared to sales, the cash flow is least likely compared to these three to be manipulated. it is not very easy to accelerate the recognition of cash flow. Okay, I'm not saying it is impossible. It is possible, but it is less likely to be possible compared to other denominators or other multiples what we are using. So here, the CF or cash flow, if we take this, it is more reliable number. Okay, again, it is more stable than the price to earnings ratio. So what's the reason? The reason is that because of the accounting practices, you might see that instability in the earnings, but the cash flow is likely to be more consistent or is likely to be more stable because accounting policies do not give you much flexibility with respect to the cash flow compared to the earnings. And the cash flow, why it is preferred multiple here, because the firm which has higher cash flow and the firm which has lower cash flow, we conclude that the firm which has higher cash flow, that firm has high quality of earnings. Because when there is a less cash earnings, more accrual earnings, it is more likely that a significant portion of the earnings is susceptible to collect. Okay. Again, the same point what we have been discussing for all other multiples is that price to cash flow is one of the reasons which explains the cross-sectional variation in the stock return, and it is proved in the empirical research. So let's discuss some of the problems with the price to cash flow. Still, it is possible to distort the cash flow. Do you have the idea that how it is possible to distort the cash flow? No idea. Any idea? By showing higher NCC, non-cash charges. Good. It can be. Okay. So you probably can recall that people sometimes use cash flow from operations in this way, or cash flow definition in this way. That is what I would say, EBITDA. So people try to represent this as a cash flow number. So you know it very well, it is not likely to be a good proxy of cash flow because of number of reasons. And other than this, this is the non-cash charges. This is the non-cash charges. So people tend to believe that if we take the cash flow from operations, that is likely to be a good proxy of cash flow. But sometimes this cash flow from operations is likely to be less reliable if the firm practices aggressive revenue recognition. If the firm practices aggressive revenue recognition or aggressive revenue practices, it is likely that cash flow number is distorted. And these are some definitions of cash flow which can be used in the denominator. Okay, but do we have a good alternative? Do we have a good alternative of this cash flow definition? So the answer is yes, we have a good definition of the cash flow. That is the free cash flow. So why the free cash flow is a good definition of the cash flow? Because we consider the changes in net working capital or investment in net working capital and investment in capital expenditure, which is likely to be ignored here in this part. So that's why the free cash flow to firm or free cash flow to equity is more reliable compared to these definitions of the cash flow. These definitions of the cash flow. Okay, so by making some aggressive policies, firm engage in generating sales. So it is not likely that if we recognize accrual sales, it is only the way of aggressive revenue recognition. Sometimes firm may engage in giving more offers for sales, but it is likely that sales will be returned. Sales will be returned later. So in that case, the cash flow numbers will further be adjusted. And there are some other avenues that how the aggressive revenues can translate to distortion of cash flow. And one of the practices is front-end loading sales. So front-end loading sales. So it is a some practices like what we mentioned earlier, that is the bill and hold. What we mentioned earlier, that is the bill and hold, and how the aggressive revenue recognition can distort the cash flow. You can look at the front and loading sales. So this is a kind of sales policy which may distort the cash flow. So look at it, and then we're spending much time here. Let's move. From the empirical evidence, it is the findings is that as analysts are more crucial, analysts are more critical about the cash flow and they look at the cash flow numbers, and the firm managers are finding more innovative ways to manage the cash flows of the firm. So how it is possible to manage the cash flow of the firms? Okay, so for example, are you familiar with the concept discounting accounts receivable? Are you familiar with this concept? Factoring accounts receivable. Factoring accounts receivable. Are you familiar with this? Factoring accounts receivable. I believe you are familiar. So when you do this, what will happen to your cash flow numbers? So your cash flow numbers will be a good number, it will go up, but it is not likely that it is a good practice because you have to face discount when you are discounting your account receivable. So why you are discounting your account receivable? Because you are likely to believe that it is not likely to be collected by you within a due period or within your expected time. So you need cash. So that's why you're discounting it or you're factoring it. So if you continue it, the discounting accounts receivable, that can be a one way that you want to raise your cash flow, but that is not a good practice. So let's see some of the alternative definitions of cash flow with which we are mostly familiar. What we are mentioning in the very first, that this is the EBITDA definition of the cash flow. EBITDA definition of the cash flow, this one. And another definition of cash flow is the cash flow from operations. And another definition of cash flow is the FCFA. And another definition of cash flow is the EBITDA here. But here what we have added, we have used the depletion. We have used the depletion term, but out of all of this, which one is more consistent? which one is more reliable. So let's try to discuss on this part. Here in the cash flow from operations, can you recall that when we estimate the free cash flow to firm, we subtract the interest expenses from the cash flow from operations. We subtract the cash flow from operations because the interest expense is something which is the compensation payable to the bondholders or the capital providers. So we want to adjust for it. And if you take the FCFE, and what are the issues with the FCFE? And FCFE is more informative because it accounts for expenditure made in working capital and capital expenditures. But the issue with the FCFE is that in the recent years of your valuation, you will see that FCFE is a negative number. So if you use the FCFE because it is more reliable, but the denominator is negative because FCFE is negative, in that case, you'll find something not useful. So EBITDA is a popular definition of cash flow, but this one, EBITDA, is more useful if the numerator is consistent. EBITDA, as I mentioned in the price to sales ratio, you can recall, this EBITDA is the representation of the cash flow of all firms, of the entire firm. So what would be the ideal candidate of numerator, the price or the enterprise value? Between price and enterprise value, which one would be more consistent if we take consistent with respect to the denominator? If we take the enterprise value or if we take the price, if our denominator is EBITDA. Yeah, if we take the enterprise value, that will be more consistent. So we have a justified price to cash flow ratio that is more simple, which is like other ratios, that what we are doing, we are taking the trailing FCFE, trailing, okay? So it is from the most recently available financial statements. We have estimated the FCFE, and we take the 1 plus G, which is more representative of the Gordon growth model, and we divide this number by R minus G. So we can use this for getting the justified price to cash flow multiple. So if we see that based on this, some firm is in terms of their price, some firm is valuing at a lower price. In the market, we would say that they are undervalued, and the vice versa. Okay, so the last multiple what we will be using, and what we just have given you the idea, that is the enterprise value and the over EBITDA. So you see that enterprise value over EBITDA is more useful for a firm which has differing leverage structure. So why? Because as you have taken the enterprise value, you are thinking of the firm as a whole in terms of a stock plus in terms of bond. But if you would take the price, that would not be consistent, and that would not represent the differences in leverage. And some firms use the capital assets in differing levels. You can recall from the leverage ratio, asset over equity. So some firms use more equity, some firms use less asset, some firms use less equity. And another ratio what we used is the sales over assets, sales over assets. So that is the ratio what we do or what we do use for looking at how the firms are using their assets efficiently. So the firms differ in terms of how they utilize their capital. So for that, enterprise value over EBITDA seems more appropriate for making comparison among the firms when they have differing degree of usage of the capital assets. And the issue of negative or the issue of negativity, which is present in the mostly in the earnings, price earnings multiple, is absent in this multiple. And the issue with this multiple is that for aggressive recognition of the revenue, this EBITDA might become less useful, and that's why it is that EBITDA is not a popular measure of cash flow. And instead of the EBITDA, which is more suggested in the denominator, is the FCFF, so which is the free cash flow to firm. So this is something additional discussion. We might need some adjustment in our multiples, which we will be using when we see that there is a differences in the company because they do business in different countries. So they are likely to follow different accounting standards. So we need to make adjustment. In addition to that, there will be differences in terms of the currency. So the currency need to be adjusted, and for inflation, the multiples need to be adjusted. So this is some higher level discussion, and for the sake of time, we are not spending time here. Okay. So that is all about for market-based valuation.